All right, perfect. Yes. So first of all, let's quickly recap the previous video before we actually move on to this video. So in the previous video, we talked about targets. Why is that important again? That is the fourth foundational level in the top right that we need to understand. So the fourth foundational level is target. That is the target of the context that you are trading. So first you have a boundary of the context. Then you have a target of that context. Within that context right there, that is where you look for your entry pattern. So once the target has been reached, you do not look for your entry pattern anymore. You do not look for new entries anymore. You do not look to get involved in the market anymore until we create new context again. And that is where this video comes in. Because once that target has been reached, once the context is gone, then what do we do? How do we go about that? Now, I first want to go over a little story on how I got to this stage and how I actually managed to create Delirium and all the other trading plans. Now, it starts back a couple of years ago where I was starting out with trading and I was just only looking at the 1 minute time frame, 5 minute time frame, 15-minute time frame. 1 hour time frame, that was way too high. Don't get me started on the 1 hour time frame. That is way too high. So again, just your typical trader, right? Just your typical starter starts out on the 1 minute time frame. And the way I developed a trading plan eventually was I was looking at the 1 minute time frame every single day. And I was first of scouting. So I was not really trading actively. I was just first of scouting, seeing, all right, this 1 minute fair value gap right there held. That 5 minute fair value gap held right there. Why did it hold? Why did that 15-minute order block at that moment in time hold? All right, what was I doing at that moment in time? I was reverse engineering my trading plan without knowing it. To be honest, I had no clue what I was doing at that moment in time. I was just going in there and figuring it out on my own. But right there, I was reverse engineering my trading plan, meaning that I started off at my entry pattern. I started off looking at my entry pattern and I slowly built my way up. As in, the next thing I understood was the target of the context. Next thing I understood was the boundary of the context. Hey, now I have context. Now I know where those 5 minute order blocks, those 15-minute order blocks, those 1 minute fair value gaps are holding. All right, now I need to see where can I find this context? Where can I find that narrative? Where can I find my bias? That is how everything originated. So we need to understand as well that with context, and once context is taken right there, that is again where you don't look to get involved anymore. You stop looking for new entries because you always need context to trading. So once context has been taken, you need new context. That can be on a different time frame. That is exactly what we are going to touch on right here. Now, because we need new context and because we're always trading in context, we always know when and where to trade. So if you're not trading in context, then essentially that's already the first step that is wrong. As in, you know why you probably lose a trade because you're not trading within context. And that is very important. You're always trading within a certain context. That is, again, moving from that PD rate to the PD rate. That is the context. Once the target has been reached, you don't look for new entries. You look for new context first. So essentially, the foundational levels that we see in the top right, they start all over again. Once context has been taken, you don't look for your entry pattern anymore. You start at 1, at the bias again. Basically, meaning that you start back all the way at the beginning. Now, do you truly start all the way back at the beginning? No, because if you still know the context, you still know the bias overall, then you don't really start back at bias. You don't start all of a sudden now, all right, let me fully reanalyze this pair right here to get to an ID. No, because you already know the bias. So the bias is like, it's a quick reminder. Do I know bias? Yes. All right, let me move on. Narrative. Perfect. Do I know the narrative? Well, I probably likely still know the narrative. Perfect. Let me find that new context. And that is exactly what we're going to look at right now. So, what do we do when the context is gone? I am going to state, I'm going to give you a general rule of thumb. Don't stick to this general rule of thumb. That might be very weird that I say that, right? Yes, I agree with you. But there's a lot of things going into play. There's a lot of factors before this general rule of thumb can actually play out. I want you to focus on the general rule of thumb, but I want you to focus on the different factors that are needed to achieve that general rule of thumb. And at the end of the video or throughout the video, I will also mention it. So that is your objective for this video, you could say. So once we reach a target, a context target, can be context high, context low. So for example, at this moment in time, we reached this low right there. That low is the target right there. So we're coming off that fair value gap, the boundary. All right, we understand the premium rate to push price lower to then target that. That is the context, premium to discount rate. Now, to add on to the targets a little bit in the previous video as well, I'm not sure if I mentioned it very clearly. So if there's any confusion about that, then let's clear that up right here. That if we move from premium to discount rate, we are always targeting, of course, a previous X low or a swing low. Ideally, 9 out of 10 times, always either a previous X low or a swing low if you're looking to target, again, a discount rate. Vice versa, of course, on a bullish side, that's a little bit different. But that is what you're doing right there. So if we have a previous X low and we also have a swing low, then you target the swing low right there. That becomes your context, not the previous X low. Now let's say there was a fair value gap in between this previous X low and this right there, and the swing low, or there was just no swing low. What you'll also sometimes see is that there's just no swing low close by. So if there's no swing low in that current order flow, then you target that previous X low. So that previous month's low in this case, the previous candle's low. But since we also have that previous month's low and then the swing low right there, we target the swing low. So this becomes the context target right there. That's quite important to understand, of course. So the next thing is that once that context target has been reached, the general rule of thumb is that you go down one time frame to look for new context. Why is that again? It's the same premise as that we use on unusual context. Unusual context is where we are looking at order flow not following through on certain time frames. But if we stay on the same time frame, we don't have that premium rate, we don't have that boundary to look to get involved. So we go down one time frame to look to get involved then. So let me give an example on that before we actually move on right here. If we ignore everything that is to the left right here. So I'm going to remove that, going to add a white thing. So let's say that we are not looking at usual context right there to continue on. So let's ignore the usual context part. Then right here, we could state, all right, we are moving higher, trying to create this fair value gap higher, and we do not do that. This creates that unusual context, right? So because we can't see that unusual context, or we can't capitalize it on the same time frame, as in if we want to capitalize on the same time frame, the same time frame should create that premium array as well, which it doesn't do because that takes too long of a time, which we talked about in the context video, etc. So then we go down one time frame to look at our usual context, to find our usual context, to capitalize on that unusual context. So right there, we go down one time frame on the weekly time frame to look at this right there. And that creates our usual context to then capitalize on the ID. So that is when you go down one time frame again for that unusual context, which we already talked about, of course. How does this relate to going down one time frame when the context is gone? Because at this moment in time, and let's look back at it a little bit, at this moment in time, once we reach this low right there, we don't have context on the monthly time frame. So to capitalize on the general idea that we are still bearish, we would go down one time frame to essentially trade this next expansion phase of that fair value gap and potentially the next fair value gap or the next candle right there lower as well, without needing to wait a whole month right now, 28 days and 23 hours, to create this new monthly fair value gap to then continue lower off of that. because this candle might already want to expand lower already. So then you would go down a singular time frame to look at that new context. So again, let's first go over this scenario, what we talked about first right there. Because we were moving from this fair value gap right there towards this low. Now, again, I have a general rule of thumb right here that I'm going to state, and you have the objective right here to sort of, again, figure out what am I trying to tell you. I won't talk about mysteries, no riddles at all, because I'm also going to clearly state it. So I don't want you to sort of understand, oh, I have to sort of figure it out. Why do I have to do that? No, I'm going to clearly state as well. I don't talk about riddles, but it is very important to understand that you sort of think with me here. Think why we are doing this. That is important. And then afterwards, I also state it very clearly. So the exceptions to the general rule of thumb is, first of all, if we still have context on the same time frame that we just took context on, so we have potential new context, then you use that context. Meaning that right here, we took monthly context in the form of this low. At that moment in time, a new monthly candle opens, which means that we have a new order flow lag low right there, which means that we have new context. We have new valid premium arrays to continue lower from on the monthly time frame. So this already creates potential monthly context lower, which means that you would not go down one time frame. That is the first exception to the rule. So that is very important as well, because we already have monthly context right there potentially. We have that boundary. We have this new target right there. So you would not go down one time frame again. That doesn't make sense, right? Because again, why would you go down one time frame if you have monthly context? Because here you can see we tried to push lower, but the weekly does not push lower because the monthly fair value gap is a stronger fair value gap because it's on the time frame above it. So that is very important. That is the reason why we do not go down one time frame if we have that condition. So in this moment in time, we are again having usual context lower to target this context low. Let me remove these things. Target this context low that is sitting right there. All right, then once we reach that low right there, we need to discuss. So you and me are going to discuss right here. Are we going down one time frame or not? Well, the answer is pretty simple. Again, and I say that because I, of course, already have the experience, already understand it fully. But the answer is pretty simple because do we have context to work with already on the monthly time frame? No, right? Because do we have a valid premium array in this new lag lower right there? No. Why not? Because we don't have a monthly fair value gap lower just yet. So we don't have any context to work with right there on the monthly time frame, new context. So this allows us right now to go down one time frame, which means that we can now go into the weekly time frame. Once we go into the weekly time frame right here, what are we seeing? We have this context low. This context low is very important right there. And the reason why that is because when you go down one time frame, it's where you now want to look for a premium array on that time frame. Ideally, a fair value gap that is overlapping with the context low that we just took. Why is that? And again, let me state that very clear to avoid any confusion. The context low that we just took is this low. It's a monthly low, right? That low is a mitigation block on the weekly time frame. So that is where these lows should be in close proximity. So should be close towards the fair value gap right there, the clear fair value gap that we want to trade off of. They are close to each other right there, creating the low right there with the fair value gap. They are overlapping, they are close to each other. That is what you want to have. Why is that? Because that leads me back to all the way to the beginning with the PD race, understanding the foundation of what we talk about right here. When price is moving, price is either seeking liquidity or it is seeking to fair value. So it's seeking to rebalance something. Fair value and rebalancing are the same thing when I talk about it. So price is either seeking liquidity or seeking fair value, to offer fair value. If we understand that, Then again, let's understand fair value. Because at this moment in time, we continue lower right there, a higher a little bit, so sell side and buy side has been offered. At that moment in time, we continued lower a little bit again, creating that new sell side. Buy side has been offered already. Overall, we need to understand that this area is already buy side, already sell side. That is fair value right there. Overall, that is fair value. So the only part where price can retrace towards is the most recent fair value gap overlapping with those lows right there, because everything beneath this right there is not fair value. Then the fair value gap right there is where you would expect the retracement towards, overlapping with the lows right there, to continue lower off of that. If that does not happen and we start to disrespect this fair value gap, then it has no reason, and as well based on weekly order flow right there, because this is weekly order flow, it has no reason to now come back above this fair value gap right there. So this fair value gap is not something you want to trade off of. This fair value gap is not something you want to trade off of. These fair value gaps is not where you would want or where you are expecting a retracement towards to then continue lower off of that. Because this is already the fair value area. So that is again, which PD rate would you use? So we know when to go down a time frame. Which PD rate would you use? The PD rate, the fair value gap that is overlapping with the context high, the context low that we just took. That is what we want to look at. That is the PD rate we want to trade off of. It's very mechanical. So that is also based on the fair value theory that we have, of course. Now, at this moment in time, we can also see, of course, that right here, do we have a swing low lower? As in, we have this boundary on the weekly time frame, right? That creates a new context. So this context low can now be taken away. Then we have this new context, the premium rate to now the discount rate. We don't have a swing low, so we can target the previous week low right there. That would be our context, premium rate to that discount rate. Once we take that right there, we can now see that we don't have new weekly context. So what do? We can go down a time frame again. Do we have something on the daily? No, because we didn't create a daily fair value gap lower. That is suspicious. But at this moment in time, we took the low, so the context low, at that moment in time. At this moment in time. So here you can look at the 4 hour. Why is that? Because here we need to understand that we didn't create new weekly context. So off of this fair value gap, we didn't create new weekly context lower just yet. We also did not create new daily context lower just yet. So that is when you can go down a second time frame to the 4 hour right there to then look for your 4 hour fair value gap that is overlapping with the context low, or at least close towards it right there, to continue lower off of that. What can we see? We come into it and we do not create a new fair value gap lower off of that. That again leads back to the fair value gap telling us a story, because that tells us that that premium rate does not want to push price lower. Once you get this price action right there, we already offered fair value higher right there, so there's no reason to come back to it. So now I would argue, all right, what is the next target? Well, potentially we have unusual context to now target this high. And that is how you use context in context in context in context. We're just reading the fair value gaps, and whilst we are doing that, we are reading context. So that becomes your sort of unusual context overall. So that is quite interesting, right? Now, again, as a general rule of thumb, and this is a little bit more general rule of thumb, where of course there are different conditions to it. As a general rule of thumb, when one context is taken and you want to trade new context, so what I mean by that, if the weekly context is taken and you want to trade new context, then if you need to go down one time frame and you need to go down another time frame, then let it be maximum of 2 time frames that you need to go down. If you need to go down from the weekly to context has been taken and you need to go find 1 hour context, that's a little bit too crazy. That's a little bit too much. So weekly, maximum 4 hour, monthly, maximum of daily, again, just maximum going down 2 time frames. That is important to understand. So that leads me overall as well to the next example that I want to go over, which is New Zealand dollar, US dollar, because this is quite an interesting example. If we look at the monthly right here and we replay this singular candle right there, then we can see that overall we have this fair value gap right there that we are pushing lower from. We don't have a swing low, so we target the previous month's low right there. Perfect. Again, this swing low is not part of our current order flow, right? So that is not something you would target at that moment in time. So then right here, once we take that previous month's low, do we have monthly context to work with at that moment in time to create new context? No. So we can allow ourselves to go down 1 time frame. Now, whilst going down 1 time frame, and we took that low right there, the context low on the monthly time frame, do we have new context here on the weekly time frame? No. So we still need to wait for the weekly potentially. Well, no. We can go down 1 more time frame. But again, that's the last time frame that we can go down to, because now we've gone down 1 time frame and now we're going to go down 2 time frames. As in, we are going into the daily, because the weekly does not have the new context. So the daily right there has context. Again, the fair value gap that is overlapping with the lows. The closest fair value gap that is overlapping with the lows right there is the PD rate that you want to trade off of to potentially continue lower. Then after that right there, we deliver into that and we continue lower again. Let me replay 1 singular day right there. Now we could again ask the same question that we did on Canadian dollar CHF, where we took this low. Do we have daily context? So is there a reason to stay on the daily time frame? No. So we can go down 1 time frame right here to potentially look at that new context again. So here, is there a clear fair value gap overlapping with the lows? This fair value gap, and that could be, I admit that could potentially be a little bit subjective. But I think we can tell that this fair value gap right there, and if you truly want to make it objective, which I would not recommend, there's a reason for that, which we're going to go into later on in the videos, is that we could tell right there that this is just not overlapping or even close to the context low that we took on the daily right there. So that is not the fair value gap you want to be trading. Then we create this very small fair value gap right there. Well, if we wanted to look for trades, then this would be the fair value gap we wanted to look for trades from. Do I like that fair value gap that small? Absolutely not. Don't like it. Why do I not like that? That is also things we're going to go into in later videos. But that is not a fair value gap I would use right there. Now, I can state one reason already why I would not want to use it. And again, the context, once you have context taken, you want to trade new context. Once that context taken, you want to trade new context. When does that end? As a general rule of thumb, once you have 2 contexts, so here you had the monthly context first overall that delivered lower right there to take this context low right there. Then we had the second context in the form that daily context, daily value gap, to continue lower towards this low right there. Those both got succeeded. So they both got taken right there at that moment in time. That is ideally when you want to stop looking at new context. Again, if price action is very clear, it's very nice, then of course, it's a general rule of thumb, meaning that there are certain conditions that need to be there in order for us to truly say, all right, now I think it's time for us to stop trading that new context. And now we're going to go over that condition, because right here, and as well, this is very similar to Canadian dollar CHF, where we had 2 contexts taken. And that is when price started to fail and start to continue higher right there overall. It didn't offer that fair value. So it's seeking liquidity higher right there overall. Understanding that, then what are we actually doing? Why can't we trade that third context right there? Because we are creating a weekly fair value gap above price action right there. Right there. Which leads me overall to the next point right there, that we want to deliver into that. And if we wanted to deliver into that, we could have continued lower potentially off of that. Now that leads me to a very important point, which is why I clearly stated the general rule of thumb at the beginning of this video. So the general thumb I am aiming at right here is going down one time frame after context has been taken. That is true if there is specific conditions, because right here you also need to understand which time frames are in context of one another. Because at that third moment in time right there, would you go into the 4 hour right there to continue lower off of that? Well, you could do that as long as you understand that at this moment in time, right there, at this close right there, that is when we create a weekly fair value gap above price action, meaning that we can easily target that weekly value gap before we continue lower overall. That is very important to understand. So once context has been taken, basically what you would be doing is you would be going from the monthly to the weekly to the daily to the 4 hour, and you would stop at the time frame that has the fair value gap that we can continue lower off of or continue higher off of. That is exactly what you would want to do. So that is also where we are now going to go over the next example over Euro US dollar. So Euro US dollar has been having some quite interesting price action. And if we take a look at the price action we went over in the previous video as well, we have this order block, which creates again that boundary to go into the 15-minute time frame, for example, to look for an entry. Then we also have this target right there. Now, the thing I'm going to show you first right here is going to, again, already add on to the execution week, because we're approaching execution week. So I want to sort of, again, ingrain that into your brain already, that we are slowly getting there. And I want to get you familiar with how we approach that also a little bit. The point of this video was the general rule of thumbs. So going down, when the context is gone, you understand what you need to do right now. That is important, which we're also, of course, going to touch on a little bit more as well. But right here, we need to understand that right there in execution phase, you would likely go into the 15-minute time frame off of that order block to look for an entry. Then once you look for an entry right there, we create all sorts of fair value gaps. And eventually you can see that we have order flow lags right there that are simply not holding. They're simply not holding at that moment in time. So why are they not holding? What happens right there? Well, we need to understand what fair value gaps are hovering below those 15-minute order flow lags. Let's first zoom out to the 1 hour time frame. On the 1 hour time frame, we see right here that we have this order flow lag right there that is also not holding. Why are those order flow lags not holding? Let's zoom out one more time frame. 4 hour time frame has a fair value gap sitting right there. So what I'm trying to tell you right there is that every time frame needs to be in context of the time frame above it again. So even though we have that daily context right there, daily discount rate to that daily premium rate in the form of that target, doesn't mean you can just go into the 15-minute time frame and look to long every 15-minute order flow lag higher. Doesn't work like that, because if we are creating fair value gaps right there on the time frames above the 15-minute, then we need to take those into account, because that leads me back again to the beginning. The higher the time frame, the stronger the time frame. So a 4 hour fair value gap is stronger than a 15-minute fair value gap. A 4 hour fair value gap is also stronger than a 1 hour fair value gap, because it's the time frame above, it's the higher time frame right there. Not necessarily it's the higher time frame, it is higher than the 15-minute time frame. That is important. Where the monthly would be stronger than the 4 hour, because the monthly is the highest one. So that's the strongest one right there. Extremely important to understand that. So right here, what you are doing, you're trading 4-hour context constantly inside daily context. So it's very important to understand, and you're constantly monitoring where the fair value gaps are being created. Because once context has been taken, you understand where the fair value gaps are constantly being created. This is going to be quite difficult, I reckon, especially if you're really new to this concept. Then this is going to be quite difficult because this requires a habit, a certain habit that most people just simply don't have, that I also didn't have when I just started using this. So the habit right there is consistently understanding where the fair value gaps around you are being created. So if I'm looking at the 5-minute time frame, I know exactly on which 5-minute candle we are now creating a 1-hour candle that is against my 5-minute order flow. Meaning that, for example, we have in this piece of price action on the 5-minute, we have very ugly price action both here in this area. So let me mark that area a little bit clearer right there. And we have ugly price action in this area right there. Other than that, this move higher is quite nice. This move higher is quite nice because those are in context. So if you have a 5-minute order flow lag higher right here, and you have a 4-hour value gap below it, is that 5-minute order flow lag in context, in alignment with the 4-hour, what the 4-hour wants to do? Absolutely not. So it first wants to come into the 4-hour to then continue higher because it's the stronger time frame. So that is, again, that is basically what I did at that moment in time. The story I started with is by looking at those 5-minute value gaps right there and thinking, why did those 5-minute value gaps, why did this one hold right there? And it's not because of a magic time. It's because the boundary from the 4-hour discount array to the 4-hour right there, premium array was sitting right there. That is very important. And as well the daily context that we have right there. So that is what you are going to be doing. You are going to be navigating, you're a master of the time frames, not necessarily a master of the fair value gaps. Because if you understand the time frames, then you understand the fair value gaps as well. Understanding the time frames, constantly being aware of what the time frames are doing is a crucial point that you need to make a habit of in trading. And if once you have that again, then it's going to become a lot easier as well. And I get this pretty often where people say, I can't really switch those time frames. As in, I can, of course, everyone can switch those time frames, but it is a habit to stay on the same time frame that we were looking at. If we stayed on the 5-minute time frame and on the 15-minute time frame at all these times, whilst these 4-hour value gaps are being created, we would get we would get blindsided, we would blow an account, it would not be great at all. Which also means that right here, we take daily context, right? We take that daily context higher. So let me delete everything from the 4-hour. We take this daily context. So the first thing someone would do that understands the general rule of thumb without understanding the specifics of it is right there, they would go into the 4-hour time frame at this moment in time to look for this long trade right there, which I would argue is overall not a super bad trade. But I do want to argue that that is lower probability than the other trades that we have seen. And the reason for that is, again, this adds on to the next video, which is going to be about high probability versus low probability. But this right here is lower probability. Why is that? Because clearly you understood the general rule of thumb very clearly. You did that great. You did it awesome. You did it perfectly. But you did not understand navigating the time frames. Because the general rule of thumb, by going down one time frame, that means you would be just constantly going down in time, going down in time, going down in time frame. Where eventually we also need to understand when time passes, we are creating fair value gaps below the context right there on the higher time frame again. So here we have created what? A weekly fair value gap that is below price action right there. So if we do not understand that, we are not aware of that, and we are getting sucked up by those timeframes and by going lower, from the 4 hour into the 1 hour, into the 15 minute, into the 5 minute, into the 1 minute, then we likely are going to ignore the fact that we are creating fair value gaps again on the timeframes above us. And once we do that, and we come into that, the process starts over. And we now create what? We create a daily fair value, daily context overlapping with that. And it starts over. Boom. What happened? We're trading into a monthly fair value gap. Process starts over. That is exactly what you need to be very, very aware of right there. So that is just simply, and I say simply because it is very simple. It needs to become a habit. So again, give that time, remind yourself consistently. And this is also what we're going to do in the execution phase. I'm going to remind you consistently that you need to zoom out. Are you aware of the fair value gaps around you? Where are your fair value gaps? Are you aware that we are about to trade into a fair value gap? Are you aware what's hovering above you or below you? That is extremely important. And if you understand that, it's going to be quite simple. And from there on, we can just add on to that as well. So again, I hope you understand the general rule of thumb, but I also hope that you understand when we would go down the time frame, stay on the same time frame. But I hope that you understand the main premise behind the video here and what you would do when the context is gone. It's simply understanding where the fair value gaps are being created on the time frames above you. Very simply said, if you struggle with this, once context has been taken, what I would want you to do is go over the monthly again, go over the weekly again, go over the daily again, go over the 4 hour again to see, all right, where are the fair value gaps? Because that led you right here. If that daily context is taken at that moment in time, you would start back at the monthly. Monthly, do you have context to trade off of? No. Weekly fair value gap right there. Need to mark it, need to wait for it to come into that first. If you're just starting out and you really struggle with navigating those timeframes, then I would advise to do that. If you're getting a little bit more advanced, then you would, again, likely do it the way I do it, that I already understand. There's a weekly fair value gap right there. And at the 4 hour right there, just already told me with that ST right there lower, that it likely wants to trade a little bit lower overall as well. So again, that is very important to understand. Practice this before we move on to the high probability versus low probability. And again, this is a thing that we are going to touch on way more and more and more, because everything is context in this mentorship. As in, we are always trading in context. So for the execution phase, everything is as well context. So this is a concept that will always return, always. So you're going to get very familiar with this over time as well. So please allow yourself to give it time. Believe me, you are going to do great. Absolutely. All right, perfect. Thank you.